Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, good morning, good evening, good tomorrow if you're in Australia. Welcome to 7 Investing Now. My name, of course, is Daniel Brooks Klein. It is October 1st. That means the new picks are out. If you're a 7 Investing member, you get access to all of our new picks this month, our highest conviction stocks. More on that later. I am being joined today by Max Chatsko. We're going to take a quick look at the rough week for the stock market. Max, it was a roller coaster, but it was a roller coaster that just goes down. There's one like that at Universal Studios that goes up, 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 and then precipitously down. But the market is up today. We're going to get to that momentarily. Then we are going to talk about, and this wasn't planned, this was kind of breaking news this morning. Merck has a cure for COVID, sort of. We are going to get to that. I'm trying so hard to not make jokes about the other things people consider a cure for COVID because people will consider that political. So I'm not going to do that. But it does seem to be very promising news as an alternate way, if you've been exposed, to make sure you don't get hospitalized. But let's hit it quickly. Before we get started, I'm going to point out that there have been some changes over at Twitter. Periscope was closed, and if you're watching this on Twitter and you send us a comment, we don't see that comment live. We're trying to figure that out with the technology. So if you want to watch this on YouTube, if you want to watch this at 7investing.com/livestream, watch it through Facebook. If we're Facebook friends, I'll share it in my feed at some point. It's probably there anyway. I think you can watch it on LinkedIn. I think we might be on MySpace. I know we're working on being on TikTok and being on pretty much every place you can be. And I am made for TikTok, as you know, Max Chatsko. I am not, sadly. But that said, so we're doing the best. We appreciate all of you watching. So if we ignore your comment, it's because we don't see your comment. And that is the problem. The vast majority of people watch this on Twitter, formerly Periscope. So we know, and we're working on it. But let's hit the top story here. That is what went wrong with the stock market this week. It was down, as I said. It was a bad week for the NASDAQ and not a great one for the Dow. Max, rising Treasury yields were the big reason behind this. There was some debt ceiling stuff. We'll talk about some of those things maybe a little bit later on. But did anything about Treasury yields or government squabbling change your opinion on any of the companies you own?
Yeah, no, absolutely not. And, at a high level, that's true, right? It doesn't matter what, for the most part, right? Treasury yields or what's going on with the debt ceiling or not, or what's going on with Congress or not. It's usually not with this Congress, right? So your thesis is your most important part of investing. And obviously those things aren't going to change your thesis. But us saying that, me saying that, Dan saying that is not a mandate to completely ignore, valuations or fundamentals for the companies that you want to own and to buy. At a high level, yes, this doesn't really change much, but investors also can't just expect that the market's going to always go up every month. There are going to be periods where, it goes down for some time or sideways, or sometimes it goes down by a lot. And that's just part of long-term investing. And especially, I've said this before, and then a week later, the market goes up higher, like Dan always says. But, eventually buy the dip is not going to work. Eventually, there is going to be some kind of correction or a little mini slide or what have you. So just do keep those things in mind. Like, of course, it doesn't really change much, but, you still have to pay attention to fundamentals and things, right, Dan?
Absolutely. I should point out, forgot to tease it, a little bit later on in the program, I'm going to have the guys from Chit Chat Money on, and they basically try to convince me why Spotify is a buy. I am not a fan, but they did a really good job. 2 very, very smart guys, friends of the program, 7 investing affiliates, but more importantly, just people we like. But yeah, Max, there are going to be crashes. This week, though, and I'll give an example. Disney's up, like $6.50 today, like $6.50. And basically that recovers what it was down earlier in the week. What changed for Disney? I guess you could argue that they settled the Scarlett Johansson lawsuit, but it didn't matter if they gave her $20 million or $200 million. Those are irrelevant numbers. We don't know what the number is. A lot of guesses are around $40 million, but we don't know what the number is. And maybe that has some impact on like talent negotiation for them. But when you're making Avengers and Star Wars movies, you can be a jerk and it doesn't matter. You're going to get talent to be in your movies. So nothing changed for Disney. It's the 50th anniversary starting today. So that doesn't change anything either. And we've seen that across a lot of companies. And Max, the Treasury yield, which everyone got so excited about, do you know what number it almost hit? Have we talked about this?
No, is it maybe like 1.5% or something? I
One
think I
and
remember saying.
1.5%.
Right, yeah.
So I understand that there's safety and 1.5% is better than zero. But 1.5% is, I don't know where that compares to the dividend yield of a lot of, relatively good stocks, but it is not all that relevant. We're not going to spend a ton of time on the market because Max is right. Long-term trends will happen and there will be reckonings. There will be companies that got ahead of their valuation that take a dip that could go for months, if not years. But right now, we're on this overreact to news. We're like a group of friends reacting to who's in the wedding party and rumors and that type of stuff where, Max hates so-and-so for a week because he thinks he's getting snubbed. And then he finds out that person just missed his text message. Like, it is very, very strange. I apologize for how ridiculous that analogy is. So let me ask, Max, is there anything you've seen over the past couple of weeks that challenges your thesis on any of the companies in your portfolio? Because I'll certainly say no in terms of me. Nothing about this, including what if we default on our debt, which is not going to happen, by the way. Nothing changes whether I believe in the companies I believe in.
Yeah, that's true. So no, for me, not so much. And again, I'm mostly invested in like drug developers, pre-commercial drug developers. But what's going on has affected the companies I recommend here at Seven Investing, for example, or what companies I'm adding in my own personal portfolio. Because I do have some companies I've owned for a while, and I think maybe their valuations have gotten a little ahead of themselves. So I've kind of backed off adding to those positions, and I'm adding to other companies that I think don't have as much maybe valuation risk or just offer a better risk reward for the next 3, 5, 10 years, whatever it might be. So again, your thesis can be intact, and the company can still be overvalued, and that does affect your future returns. So that's how I'm kind of approaching what's going on in the market, Dan. Now, let me ask you something. Is this actually an overreaction? I mean, I think, I don't know, in the context of things, when the market goes up so much for so long, for such a consistent, upward trend, and then like the slightest hint of bad news, it goes down, or maybe down for a whole week, or maybe a little correction. I understand what you're saying. That's maybe not the sky is not falling. So you're right about that. But I mean, it kind of sort of makes sense that maybe investors are saying like, oh, okay, I guess maybe, we also have to consider that stocks do go down every once in a while.
It's the broad strokes that I take issue with. And that segs nicely into how I want to close this segment out. And we would love your questions and comments. We have a taped interview next, but I will be around at the end of the show. If you want to comment, I know it's a Friday. This is not the most commented show of the week, and we are dealing with that Twitter issue. But I wanted to talk a little bit about retail. Why? Because every lousy retailer is going to say, oh, we're having a bad quarter because of supply chains and it's really hard to get stuff. You know who doesn't have issue with supply chains? The absolute best tippy top retailers. Now, that doesn't mean that, say, Walmart and Amazon or Marshalls and the TJX companies or Five Below or whoever it is, that doesn't mean that they're not going to be out of the specific one something or 10 somethings or 100 somethings. But you're not going to go to Walmart and be like, there's no pancake mix, or maybe there could be something completely exclusive like that that's out, but there's not going to be like, there's no breakfast foods. So a lot of this is just noise. And why do I bring this up? Because retail has fallen across the board. And this is companies, and I'll go back to, and I said this to you before the show, Max, when I ran the toy store, I placed my Lego order a year in advance. And if Walmart wanted my Legos because they were selling more Legos, or back then Toys R Us wanted my Legos because they were selling more than they expected, you know whose Lego order mysteriously didn't show up? Mine. The big fish win here. And we saw this with Home Depot. We've seen this with Costco. The big companies have the ability to go hire an armada and go out and get their stuff. So yeah, might you go to your favorite supermarket here in Florida? You might go to Publix and they're out of Bounty paper towels and you have to pick between Brawny and Viva. I've often joked that this is the golden age of Brawny during paper towels. But when you watch all of these executives, and it's Bed Bath & Beyond that got me irritated, because this is a company that's not particularly well run, that's shown some signs of life in the last couple of quarters, but everything they sell I can buy someplace else. So maybe the reason their August sales were down were because people bought things other places because they're not a super relevant brand. And again, when a company does a press conference or explains quarterly results, the CEO always has to say like, well, there was a trend, like the weather was bad in the Northeast, or we really saw that people were spending their money on this. They never come up and say like, hey, you know what? I'm not that great at my job. Like, because you can't do that, you will lose your job. Like, I wouldn't expect anyone to do that, but you certainly can read between the lines when it comes to some of these things. Max, let's close out. Is there anything else you are watching in the market? I'm trying to disconnect from the daily up and down, which is of course impossible to do given how much time we spend researching. Like you really can't not see it. And it's also like right on my phone. But that being said, is there anything you're paying attention to right now?
No, I mean, I think the higher level stuff still is intact, right? You have like, what is the Fed going to do? And that's going to play out over time, like maybe through the end of 2022 or even later than that, right? So it's not like that's not going to jump up on us. Of course, there's always those unknown unknowns like the Evergrande thing in China. The market's already kind of, shaken that off, I think. So, but no, for the most part, I mean, it's still steady state. I'm just looking at the companies I own, making sure they're executing. Making sure those de-risking events are falling in my favor, hopefully. And not much has really changed. I mean, there's always weird macro things, but those tend to take longer to play out, right?
They do. And it's why, like, if you believe in a company, it doesn't really matter what it's doing right now. And that segs into, today is the first of the month. What happens at 7 Investing on the first of the month? First of all, it stinks that it's a Friday. It stinks that it's a show day because we have all sorts of things that go out on Friday, all sorts of news. But our new picks come out. What do I mean when I say our new picks? Each one of the 7 advisors here at 7 Investing is tasked with coming up with our highest conviction stock pick for the month. And we all wrestle with those decisions. We then do a write-up. I believe mine topped 3,000 words, not that it's by the word, but so you could dive in and read the whole thing. You could just read the key takeaway. Maybe you'll see my company and you'll want to know, geez, why now? You can search for that. Maybe you're like, well, I like that company, but what's their management like? What's their valuation? You can just jump around to those sections. You'll also be able to watch the deep dive video presentations. We all make a PowerPoint. We present to the other members of the team and everyone can ask questions. And I'll say, my pick this month is a company you've heard of. It is a company you're going to go, oh, I like that company, but should I invest in it? What is Dan's case for that? And I'm going to argue I make a pretty compelling case. Max, his company is not necessarily one you've heard of, and we have a very diverse array of picks. JT, if you want to share that graphic, Max, if you want to, so Max puts this together every month. This just gives you an overview. We have multiple. There are 3 very high risk picks. We have my pick, which I would consider low risk. Matt Cochran picked one that's high risk. So they go all over the board. I see some small caps. I see some large caps. So if you are coming to 7 Investing and you want to be a member, there is something for everyone. How do you become a member? That is very simple. You go to 7 Investing, and JT, you can take that down. You go to 7investing.com/subscribe. Once you're there, you fill out a really simple form. We ask you your name. We ask you your email address. We ask you for credit card info. That is, of course, all secure. And you give us either $49 a month or $399 a year, which is roughly 4 months free. You can pick whichever months you consider the free ones. Maybe it's December, your budget's all stressed out. You're like, that's a free month. I didn't pay that month. That is not really how it works. You just pay all at once and we give it to you for that. And if you use code NOW, that is NOW, you save $10 off your first month or $10 off an annual subscription. If, of course, you are a student, we have our $84 a year annual subscription for students. If you are a full-time student and don't have an email address that works in our system, just shoot us a message at info@7investing.com. Not going to belabor this. Max, I know it is an incredibly busy day. For those of you watching, Max does a lot of the stuff to get the picks ready. We are not all necessarily getting every comma correct or putting our photos in the right places or formatting everything. Max goes in and does an edit along with Steve Simonton, does some of the work and gets everything ready. So when midnight hits on the 1st, or it's more like 9 a.m., these picks can get sent out. And when I say 9 a.m., I of course mean Eastern, the one true time zone. Please don't send me hate mail if you're from
No,
another.
that's right. This is real life time. And yeah, if there's any typos or anything, you know who to yell at. Thanks for Dan for channeling everyone's anger towards me. Yell at me. That's good. Thanks.
I think we've all seen my Twitter and know that typos are very likely me. To be fair, I am much better at typing on a keyboard than I am at typing on my phone. But Max, we are going to let you get out of here, and I am going to introduce. I did a wonderful intro.
We got to let's talk about the COVID.
Oh dear God, I forgot. We have another topic.
Right. We're all over the place. That's fine. We added this last minute, so that's
sorry.
Fine.
This is very last minute, but I teased it at the beginning, so it'd be very bad if I didn't do it. So I woke up this morning. To be fair, there were some rumors of this yesterday. But there is a new drug that basically has done so well in trials that Merck has gone to the FDA and said, do we really have to do any more trials? Like, I know that's not the technical thing that happened. But Max, what is this drug? What does it do? And how might it be a useful tool, no hyperbole if possible, in the battle against COVID, which I picture as looking somewhat like the old Colgate commercials where they fought the cavity creeps. But that is probably before your time and also not relevant as a way of picturing this. But Max, what has Merck done and what does it mean?
Yes, this is interesting because Merck came out in the pandemic, and obviously it's a big opportunity not only to help people, maybe help the world get out of the pandemic, but also, a good way to generate some revenue and some profits if you can develop a vaccine or a treatment. We've seen that, of course, with the initial vaccines. Those are going to generate tens of billions of dollars in revenue this year, also probably next year as well. Merck actually tried to develop 2 vaccines, and they just weren't really, up to par. Maybe a little too little, maybe a little too late. Developing some other treatments. Maybe they nixed those in clinical trials as well. But one of the big acquisitions they made relatively early on in the pandemic was of Ridgeback Biotherapeutics. And this company makes antivirals. So things that go in and maybe disrupt how viruses can replicate within your body. So it's kind of adding to what your immune system is already doing to protect yourself against these infections. So they were developing an oral pill. You take it every day, an antiviral. And this is after you've been diagnosed to have COVID, and you take this and maybe it lessens your symptoms. It helps you to avoid having severe disease or maybe ending up in the hospital. And they were running a big clinical trial testing this oral daily antiviral. And like Dan said, I mean, it worked so well that the FDA was like, hey, why don't you close this up early? Why don't you submit this for approval, and we'll go from there. So they're hoping to have approval of this daily antiviral that you take by mouth before the end of the year. They're going to maybe have 10 million treatments available. Again, there's daily dosing, so 10 million treatments is not necessarily treating 10 million people. But this is a really nice arrow in the quiver, especially we've seen like there's just, for whatever reason, in some parts of the country, there's lower vaccination rates. But, if push came to shove and you did actually get infected and you didn't want to end up in the hospital, this now provides a very easy and convenient way to maybe quite significantly lower the amount of individuals who have severe disease or end up in the hospital. It's about 50% reductions. So, I mean, that could be good for freeing up, beds in the hospital for more serious conditions, things that are not preventable, like COVID is now. And maybe even, again, like people don't want to get the vaccine. Fine, we won't get into that. But now at least you have this very convenient option as well. So this is really good.
Dear God, we won't get into that. But even whether you've had the vaccine or you haven't, and we're all vaccinated, or at least the 2 of us are, and we've talked about it publicly, or at least I think we have. And so sorry if I just said something I shouldn't have, but I think we've talked about it publicly. But that being said, so Max, if people get this, and yes, it will be bad to give 10 million people 1 dose. That would not be very effective. So, but if people get this and we have the number of hospitalizations, that has a bigger effect, right, than just keeping half the people out of the hospital. It also frees up care. So it opens up hospital beds, not just for people with COVID who need that special attention, but also for like the guy who had a heart attack or the woman who broke her ankle or whatever it might be. So if we could have this happen and half the cases don't go to the hospital, the actual benefit should be bigger than half, right? And I know I'm not expecting you to give an actual number. It's just sort of anecdotally, there should be longer reaching effects of this, right?
Yeah, exactly. So this is not like 1 + 1 = 2. It's more like 1 + 1 = like 7, maybe, right? This is a very nice thing to have for hospitals and for the country. The company says it's relatively easy to manufacture these. I'm not really sure if that's true. Antivirals have some complicated process involved, but if they're already intended to have like 10 million treatments before the end of the year, then, I mean, they did have a long time to maybe get the supply chains in place for, some of the really weird reagents you need to make these things, this specific treatment. So maybe that is believable, and they're going to have more available, more than 10 million treatments available in 2022. So, I mean, this is really nice. And again, it's more convenient than like, you go to the hospital and maybe you need to take antibody administration because you need to get that through an intravenous infusion. that could take an hour, maybe 2 hours. You need to go to a special facility that has that infrastructure. Something like this, I mean, you could literally go to the pharmacy, pick it up, and then just take it at home, right? So this is like really, it's hard to understate.
Or better yet, go to a telemedicine appointment, get it, and have the pharmacy deliver because you have COVID. So don't go to the pharmacy.
Yeah,
if you can possibly avoid that. Depending where you live, there are all sorts of delivery services that for this type of drug, not for certain controlled substances, but for this type of drug, depends where you live. The laws vary a lot by state. This is really encouraging. And what I said to Max this morning, and we'll let him go in a second here. What I said to Max this morning is, I'm just amazed by science. It is the problem with science, not the problem with science, but it's probably frustrating as a scientist to be working for like 20 years on something and amazing advancements have been made, but the right scenario hasn't come up or you haven't hit the end point. So it's basically like telling your friends like you're writing a novel and your novel's great, or at least you think it is, but they don't know anything about it until it's released. We've actually seen just how powerful some things are. We obviously learned that the mRNA platform has the ability to be transformative. And when we see the ability to quickly spin up an antiviral that could be another tool in controlling this pandemic, makes me feel good about humanity. And I don't always feel great about humanity. I think anyone could probably say that. But Max Schatzko, you have work to do. Gonna let you get back to doing that. I totally appreciate you popping in. It is a tough day for the 7 Investing team. We are pulled in all sorts of direction. JT, if you want to come in just on me so Max can leave without it being so obvious. At this point, I want to bring up, we are going to go to a really interesting interview I did with the guys from Chit Chat Money, friends of the family. We've had them on the show before. I will point out that we did this interview in late August, right when Spotify reported, and we had technical difficulties. We finally have the video working, I think. So sit back. It's about 22 minutes long. I will join you at the end. If you have any questions, please ask. But thank you, JT, if you want to hit the video.
Welcome back to 7 Investing Now. As we've discussed, Spotify just reported Q2 earnings and its share price fell after it missed on subscriber totals. Basically, they gave a guidance, they didn't hit that guidance. I don't put very much stock into any sort of stock movement right now because I feel like with a lot of stocks, people are either looking to pick out one positive thing, like, wow, hey, this company, like everything's bad, but they didn't burn anything down, and then the stock will go up. Or they'll cherry pick one bad number. I do think this is a cherry pick of one bad number. But the company did fall right after earnings. It's recovered some of that. But I wanted to invite our friends from Chit Chat Money, Ryan Henderson and Brett Schafer, to talk about their long-term belief in the streaming music company. Gentlemen, it's been a while. Welcome back to 7 Investing Now.
Thanks for having us.
Thanks, Dan. It is so we are recording this on a Thursday. I'm doing it with a relatively limited amount of sleep, so apologies if I am not as sharp as usual. But let me just lay out the core case of why I don't own Spotify. Their basic product is music streaming. Music streaming has a set price. You cannot cost more than Apple. You cannot charge more than Amazon. And then there's dueling people who want money. The labels want their share, and artists are increasingly speaking up and saying, hey, this is not fair. Now, there's some room in cutting out the label. If you're Taylor Swift, maybe you could do that. If you're nobody, you don't have a label. But everybody in the middle has this pressure. So that's what I don't like about Spotify. They don't have a lot of pricing control. There's not a lot of margin there. I love the podcast business. If they could spin off the podcast business, though I think Joe Rogan's going to end up biting them in the foot, but if they could spin off the Ringer and all the other stuff they own, I think that would be a great investable business. But guys, you believe in this company way more than I do. Tell me why I'm wrong.
All right, I'll hit it first. And yeah, I think you are right initially on the music stuff, and that is the majority of their business right now. I guess I'll probably go through some of the numbers just for giving a reference for anyone. So if you look at the financials, and these are going to be in euros, which is pretty close to the dollar, but their total revenue in Q2, premium was 2 billion euros, and then ad supported is 275 million euros. So the majority of their business right now is from the premium music subscription. And I think you are right that the pricing power, or excuse me, not the pricing power, I think we do disagree on the pricing power part, but the margin side on the premium music subscriptions are not going to expand that much. Although I will say that it has incrementally gone up. Last quarter, it was at 28.4%, and that is up historically, what is it, Ryan? Down closer to 25%, something like that. And it is a bit lumpy, but there is some room there. And yeah, you know, there are some troubles with the labels and the artists and stuff like that. But one reason we really like Spotify is some of the numbers they give out on the music side with the engagement that their users have with the product. So they have 2 to 3 times the engagement of, say, they call it their competitors. But when they say that, I believe they are meaning Apple Music, YouTube Music, or Amazon Music. And when you hear that, that means they have 2 to 3 times the engagement. And then that means, though, that when they're paying out the stream per, paying out the artist, the number that they pay out per stream is going to be less. And that looks bad in a headline number. But that number really doesn't matter because it's all just based on subscriber pools. And Spotify pays out an increasing amount to the publishing labels. If you look at some of the numbers they give out, over 870 artists generated $1 million or more from streaming royalties in 2020, and that is up 90% from 2017. Is a lot of that going to the labels? Yes, but Spotify is increasingly providing value, and they're being, what's streaming now? 62%, I think, of all music revenue.
Yeah, they've kind of, so I would credit Spotify to almost all of it, but the music revenue in the music industry has returned to growth for like the first time, and it was declining for what, like 10 years?
10, 15 years because of the pirating and stuff like that. And Spotify was the one that saved them. And we say all that stuff, and that might not mean much financially, but 2 things that may mean, could help financially is, 1, the discovery marketplace. They're doing this thing where labels basically get gross profit kickbacks for promoting their artists on either the homepage or by notifications that get popped up or from insertions into Spotify's playlists. And a lot of these playlists have really, really, they're used every day by a lot of people. You have Discover Weekly, you got
Rap
Daily
Caviar.
Drive, Rap Caviar. I think they give out numbers about, I think Discover Weekly hit like 12 billion listens or something like that. I could be getting the name of that one wrong, but that is a great way for them to give margins back. Dan, you had something?
Yeah, let me jump in, because this is a lot like paying for end cap space in a grocery store, or paying to be on the new and noteworthy table at Barnes and Noble. And I've talked about when my book was on that table, it sold thousands of copies, and when it wasn't, it didn't. But that being said, it still has to be good, right? Because if I'm listening to the middle-aged dad rock playlist on Spotify, and all of a sudden it's a bunch of stuff I don't want to listen to, well, they're going to lose that pricing power. So there's a really tough negotiation there of taking the money and making sure the songs would actually be playable on that playlist.
Yeah, one thing I maybe get pushback on that is that Spotify has been really, really good. And one of the ways we believe they differentiated from the competition is the way they've curated listening and curated artists for their consumers. And that is the reason, I think the proof is there that people use it 2 to 3 times more than the competition. So they're able to find songs for you. Again, Discover Weekly was the big clear one here. I'll give one stat here. So from the from the two-sided marketplace, they gave out last quarter the discovery mode. If you use it, they have found over 40% more listeners on average compared to being on pre-discovery mode. And then additionally, 44% of those listeners have never listened to the artist before. So one of the big important, streaming for an artist, it's not where they make the most of their money. Most of the money is made in live shows or other ancillary products like that. So streaming is really for artist discovery. And if you can boost, the people that have found you by 40%, that indicates to us that the value is there and that the two-sided marketplace can be strong. And then there's one other thing I have, but Ryan, did you have anything else to add there?
I'd also add that it is sort of a commoditized service wrapped in a much better app and a much better experience and more personalization, because they're getting, and I think the numbers kind of prove that out. I think they have 365 million total monthly active users, and I think the second closest was Apple with 70 million as the last report.
Yeah, it's hard to compare because they do not update every quarter. But
yeah, so it's just I think there is, but to your point, there's always going to be a cap because you have to pay out the rights holders. And so there might be a little wiggle room in there in terms of growing their slice of the pie. But overall, what they're doing is growing the pie entirely in music. And then, I mean, am I missing anything on the music side?
No, I mean, the margins aren't going to be super high, but at probably about 30% over the long term, that's not a terrible business, especially as a subscription. So they can make money on that. Are they going to have 30% operating margins like some of these other software businesses? No way is that going to happen. But the other thing I'd add is, so a lot of people think that Spotify does not have pricing power, but they have actually been raising prices in a few markets, and churn did not go down overall. Now, they only raised it in a few markets, and they're testing out some things. So while churn is still falling and they have the ability to raise prices, that indicates to us that they may have more pricing power than you assume, because at first you think, it is a commodity product, but the customer lock-in with these things, you have all your playlists on there, you have all your downloaded songs, they know what type of playlist they want, they're feeding you the songs that you want. That we believe, and we could be wrong, and they might not have as much pricing power as we think, but we believe because of that, they're going to have more, it's less of a commodity than people assume, and the ability to raise prices is a lot stronger. Will it be incremental? Will it be not as much as maybe a Netflix? We think that's the case. But then interestingly, if they raise prices, that is more being paid out to the artists. So that is something that can really help improve their relationships with the artists, with the labels, versus someone like Apple Music if they're trying to sell it for a cheaper and cheaper price. I hope that makes sense.
Yeah, no. So the optics with the artists are never going to work because Apple can always target the 500 most important artists and throw a concert, pay them to do documentaries. There's other ways they're making good, and Spotify could do that to a very small point, but they don't have they don't need, Apple doesn't need to make any money on music. It's just a value add for everything else. So that to me is tough to compete with. The challenge with Spotify for me, because I think you're right. I think they have $1 or $2 of pricing ability where if I'm paying $10.99 for Apple Music versus $12.99 for Spotify, I don't think I care if I'm enmeshed in one or the other. Now, for me, I don't see any differences. And let me ask you guys the question. So here's how I discover music. I'm a 47-year-old man. Most of my musical taste developed in college. And now here's how I discover new musicians. It's almost always Saturday Night Live. Like generally, whoever the artist is, and there's usually one or two a year. And I'll give a weird example. Never heard of Olivia Rodrigo until Saturday Night Live, because why would I? I'm a 47-year-old man. And while it's not my music, you can hear the Taylor Swift influence, and I like the recent Taylor Swift albums. And I get it. Like, I understand it. But the one I really like, Machine Gun Kelly, was on SNL this year. Never heard of him until he appeared. Went to listen to his back catalog. It's all terrible, but his current album is really, really good and is an incredible step forward. I'm not listening to Discovery whatever, hearing 100 songs, hoping I'm going to hear two. I'm curious at your age. Are you guys just like putting on music and hearing things? Like even in college, like I generally just listened to the music my friends told me that they liked, and I liked a lot of it.
Well, I do.
I mean, you do get that, anecdotal people tossing stuff back and forth, but
I think you're right that a lot of the listening habits actually are formed in college, and I think that's why they discount the college subscription. And then, I mean, I guess our habits are probably different. So like my parents, they used to like know everything by the album, whereas we just kind of know them by the song. And usually it's because it's lumped in to a playlist that we're subscribed to. And then you're like, oh, you like that song, you download it and you add it to your own playlist. But as far as with the pricing power, back to that, they give a churn number, and if they really usually discount early on so they can start to slowly incrementally increase prices as you've been with them longer. They're obviously not going to do that in their like a brand new market, because that's probably a bad look. But I would say we are kind of belaboring the music point, and I think the part of the business that we like the best, and it sounds like you like the best, but maybe it's because we're talking our book, is the podcast.
I mean, we should be clear that we use one of the assets Spotify has is Megaphone. We use their marketplace for the advertising, so I guess we have a lot of anecdotal evidence with that as well.
Yeah, unless you have any more questions.
No, I think so here's the thing. I love the podcast business. I thought 400 million or whatever they paid for the Ringer was brilliant. Bill Simmons on his own is probably paying for that deal, and they basically have an endless ability to launch new podcasts. Bill Simmons, if you're listening, there is no finance or stock market podcast on the Ringer or on Spotify of any note. Give me a call. But that being said, I think there's a lot of ability to grow there. But I do think there's a cap for that as well, where there's so much competition. Someone like a Joe Rogan or what is it? Call Me Daddy, which they just signed up. There's only so many of those out there, and any of those like super controversial ones, you're walking a tightrope. Like if you told me tomorrow Joe Rogan said something that Spotify had to cut ties, it wouldn't shock me. So I wonder a lot about. That's a great business, and they're the leader in it. I wonder how big that business can be. Give me your thoughts, and we'll close out with this.
Yeah, and so that is part of that's part of the worries there with the podcasting side is sort of what's the addressable market look like, and it's worth noting that they own like the podcasts themselves. That's part of their podcasting strategy where they have the Ringer, Joe Rogan, Call Her Daddy, and that's sort of their originals and exclusives. But another part that we like is they own the distribution. So even if Apple Podcasts grows its listeners, the amount of users on Apple Podcasts, they're making money off that, because if whatever the podcast is being distributed on Megaphone or Anchor. So I don't know what you guys distribute yours on, but we use Megaphone, and they have basically the best and maybe the only ad targeted marketplace that's automated. And the way to think about that is it's a bit like a YouTube, where we submit where the ad inventory would be, and then advertisers can automatically bid on it. And it just gets inserted, so we don't have to record that advertisement or anything like that. And so that part is growing. Right now it's at about just north of $1 billion revenue run rate.
And that's including music.
But it's, I would say, I'm guessing mostly podcasts. And it's actually growing. So they categorize that as ad supported revenue. And that's actually growing 200%, more than 200% organically, and 600% for them inorganically at north of $1 billion revenue run rate. And while it's hard to put, you kind of have to ballpark numbers on it. I think we compare it a bit to linear TV versus smart TVs, and the advertisers shifting over, where it's like linear radio versus on-demand audio. We think that's early in the shift from radio advertisers to on-demand audio advertisers. And I think
while the audience is already over there. So for example, when Roku used to have all those listeners, but they were struggling to get advertisers in 2016, 2017, you're like, well, how many advertisers are actually on streaming TV? It takes a few years. Now, the majority of people in Western markets are listening to podcasts now, but the advertising inventory has struggled to get over there. One of the reasons for that is that Apple has been the big winner overall. They basically invented podcasts because it's iPod, podcast. That's kind of how it started. But they don't care at all. They just have it through the RSS feed. They give you no data on your shows. Well, they give you minimal data. And they also have it download only. So it's really hard to track how well the advertisers are doing. So the reason saying is that advertisers had no incentive to go onto some sort of inventory thing. Apple was not helping them out at all, but Spotify is trying to do that. It might just take a few years.
And I know I got to go pretty quick here, I guess, but it is a small portion of their business right now. But even on the last conference call, the CEO, Daniel Ek, said, this is going to be a substantial part of our revenue mix moving forward. The days of it being less than 10% are gone. We see that continuing to grow. We can see advertisers continuing to shift over to podcasts because it's a better value proposition for them. They can target people based on data, location, listening habits, age, whatever the data they provide is. So that is probably the crux of our bullishness, is the outside of music audio.
Yeah, and I'll add on two more things maybe. This is something that Megaphone gave us. They have a monthly newsletter, and it's one of the reasons why we are happy as a Spotify / Megaphone customer. So when we put those advertising slots in, right now, what would you say? It's probably half get filled at best. It's not nearly as good of a fill rate as YouTube. But last quarter, they said, they gave us an update that fill rates had increased 10%. CPMs, which is the advertising per 1,000 listens, increased 40%. So what people are paying per advertising slot was up 40%, and that is because of Spotify's targeting capabilities. And then the number of unique advertisers nearly doubled for some publishers. That's a bit vague, but still, everything's headed in the right direction. So even if, say, podcasting advertising doesn't grow, podcast listenership doesn't grow from its existing inventory, even if they just get the fill rates basically from half to full, they could double revenue in that. And there's also, 2 or 3 other strong tailwinds just from overall listenership going up. Podcasting itself, listenership around the world is growing at a double-digit rate. And then, what's the other one? Oh, listenership on Spotify is growing at like a double-digit rate. They're taking market share from Apple at an impressive rate. And yes, Anchor and Megaphone can get advertisements out to Apple and other places, but the concern is with Apple, you don't get the data because it's just downloaded and stuff like that. So the more that's on Spotify, the more it's vertically integrated, the higher and higher the CPM rates will go. And that means more money for Spotify. It means more money for creators, and it means better targeting, hopefully, for the listeners, and that's not like a benefit for them or anything like that, but it's really helping say.
No, absolutely, it's a benefit. So if you remember the old days of podcasts, and you heard me on many a podcast where Chris Hill would be touting MeUndies or whatever the generic food service or whatever it was. If I'm listening to something and it targets an ad to me that's well targeted, it's something I'm looking for, which is not usually the case, that ad becomes content. I think that's something Facebook has done really well. Just a couple of notes as we close out here. There is more advertising moving to digital television, but it's not moving from linear television. It's important to note that advertising rates post-pandemic are actually up on linear television, and they're very up in sports. So there's just more effectiveness to it. So there's more dollars. Where we're losing dollars is on a local radio market. There's very little actual local radio if you don't live in a major city. So companies that used to be obvious, when I used to run a toy store, we advertised on our local radio station that old guys who build models, like to listen to. And then when that stopped being a live thing and started being just syndicated programming, well, we ran cable ads on the History Channel because that's what old guys who build models are watching. Sorry, people who I'm stereotyping, but that's how we targeted our ads. So I do think this is all going to get bigger. But guys, explain to me, all of these seem like relatively tight margins with growth, but not massive growth. So why Spotify and not Disney or Apple? And I'm going to guess you probably both own both of those also. So that's a terrible example. But
I get what you mean there. So the podcast advertising margins are very, very high. You don't see that on the income statement right now, but Spotify itself, they're guiding for 20 to 40% of revenue to be coming from advertising over time. And their guide for gross margins to get up to 40%, which isn't crazy high, but that's with the premium subscriptions at 30%, margins max. So with the gross margins, and that's not true profitability, are a lot higher on podcasting than I think people see right now, because ad supported, it's a bit.
So content costs, all content costs, like podcast related content costs, gets lumped into the cost of revenue under ad supported. So it's not really representative of the profitability of their podcast side. I mean, you run a podcast. Costs are basically a microphone and maybe a Zoom subscription. It's very high margin, just naturally. That's just the type of business that it is. And then, so the podcasts they own, the originals and exclusives, are high margin. And then the ad platform that they own has a 50% take rate, and there's very little variable costs. They are essentially just garnering money every time an advertiser bids on ad inventory. So it really is, I think it's masqueraded by the content costs, but I think underneath it's a really profitable business.
And that adds some risk because you have to not look at what Spotify is doing right now, and you have to kind of put on some rosy colored glasses and say, all right, this is what it could look 3 to 5 years from now. And we will caveat that does add some risk, but if you believe in that, and we believe that you can see it from, what they're doing and how they're really eating market share from Apple, and no one else is focusing on audio this heavily. With that's the bet we're willing to make.
But then again, we're biased because we have a podcast.
That colors my thinking as well. Ryan Henderson, Brett Schafer, thank you for doing this. I have so many more questions, but we'll ask them off the air after we stop this so we don't go on too long. I will now throw it back to myself. I don't know where I am because I think this is going to air Monday, so I think I'm going to be in Orlando, but I can't 100% promise that.
I was only off by roughly 35 days about when I would air that. I appreciate all of you watching. The Chit Chat Money guys, go check out their programming. They do a wonderful job. We will have them back on the program. Thank you for sticking around. We are near the end. At JT Street, if you want to bring up our finisher, let's take this thing home. Which segment are you most confident about over the next decade? About 21% of you said electric vehicles. About 47% of you said technology. A lot of you pointed out in the comments that all of these are technology in some fashion. About 28% said payments, and about 3.6% said space. I actually think it's payments. We are in the beginning of a massive disruption of the traditional banking system. Now, if I said 20 years, I think it would have been space. When it comes to electric vehicles, I actually think it's going to take longer than people think. We appreciate you sticking around. We know it's a Friday. If you're listening to this as a podcast, we appreciate that. Please give us a thumbs up, a 5-star rating, or whatever it is, wherever you happen to be getting 7 Investing Now. And of course, the 7 Investing podcast, which airs on Tuesday and Thursday. That is more live, long-form interviews, whereas this is more of a free-flowing show responding to the news of the day. If you would like to get in touch with us, that is info@7investing.com. That is questions about your membership, questions about how to find something on the site. Maybe you are a member, maybe you want to be a member, anything like that. Send it to info@7investing.com. If you would like to interact with us, we are at 7investing on Twitter. And remember, it's the first of the month. Our new picks are out. If you join, not only do you get those picks, you also get all of our past picks ever. Use subscription code now. Sign up at 7investing.com/subscribe for Max Chatsko, for the Chit Chat Money guys, for Ryan and Brett, for JT Street, for Sam Bailey, for everyone back at their various 7 Investing homes. We will see you again on Monday. Thanks, everybody.